top 10 common mortgage questions for 2024. So we're going to do a bunch of shorts on this, and we're going to address a lot of questions out there that we get a lot from people coming or wanting to know about mortgages. So you ready?
Let's do it.
So he hasn't looked over these. I know a lot of these are basic, but it's nice to refresh these. So the first question is, how do you qualify for a loan?
You start by having your credit checked and look at your liabilities and compare that to your capacity for the new loan payment, which is your income. And then you figure out what that budget is and find a house that fits.
All right, so quick question. What is the loan? You have a whole bunch of liabilities. What's your debts, just to clear that up?
Yeah.
Between your student loans, your car payment, your credit cards, and your mortgage, what % of your income can that be?
So you figured like
approximately.
So your credit cards, we look at the minimum payment on the credit card. Your car loan, the minimum payment's the payment.
It's monthly. So this is monthly.
Yeah, this is monthly. So it's all going to come down to, compared to your income, what's the debt to income ratio? Generally, you can get, if you follow the straight manual guidelines, says it should be no more than 43%. So if you're in a jumbo loan or any kind of a non-conforming loan, 43% is typically the limit. When you get into like the Fannie Mae or even FHA, they can get to 50+% total debt to income ratio. When you take your house payment, the new payment that you're going to buy the house with, and then add your other expenses. And it's interesting, we use gross income. So if you get a $100,000 a year salary, you don't see $100,000 in your bank account, but we do look at that, and we could take 50% of that. So you could have $5,000 or $50,000
about.
Yeah, as your total expenses just to get by with your minimum on your credit card. So it's pretty loose, I would say, but at this prices and at the interest rates that we're seeing, people are pushing the limit every day.
I mean, we see a lot of high mortgage, and I think I put online that in COVID, for this nationally, $2,400 was the mortgage payment for a $500,000 loan. Pre-COVID, now it's up $2,400. Now it's up to $3,200. So $800 a month increase.
Big increase. Yeah.
Big increase. So now we get this question a lot, and I've never asked this on the podcast. So you ready?
All right.
Question 2. Can you get a mortgage without a credit score? So there's FICO scores, their credit score. So can you obtain a mortgage without a credit score? If so, how?
So a credit score is based on somebody else reporting the good and the bad about you, right? So you take out a car loan, the bank says that you made your payment on time. So if you don't take out a car loan and you don't take out any credit cards and you don't have any collection accounts, you will not have a credit record. But you can do alternative trade lines and you can get a loan with no credit score. It's totally possible, but you have to be able to verify a bunch of things. Like, what are your housing expenses? So do you rent an apartment and we can contact a licensed landlord and they can verify that you're on time with your payments? Or can you provide 12 or 24 months of your checks that you wrote every single month? That's your housing expense. And if you paid your utility bills and your gym membership and you have 3 to 5 total trade lines, including 2 to 3 from housing expenses like your utilities and your rent, you can absolutely get a mortgage without a credit score.
So that's a very interesting thing that I've never heard. But it has come up because occasionally we'll come across clients that pay everything in cash. No credit cards, no debt. They say, I want to be debt free, and this is, if you're debt free, congratulations. So there's a way around it, because a lot of those people don't have credit cards, so when you pull their credit, it can be zero, right? Can you have a zero credit card?
You don't have zero, it just says NA.
NA.
Yeah, absolutely.
So
if you don't have any bad credit, that's kind of the start, because a lot of people stop using credit because they screw it up, and that's a little bit of 10 or too late at that point. You need to offset it. And it really, if you didn't have credit and you literally had a clean slate, in less than 6 months, you could have an awesome credit score. So it wouldn't be that hard to develop a credit score if you just put some thought into it. But some people just want to be off the grid, so to speak. You can get a loan. It's just going to be a little bit more of a headache.
Yeah, a little bit more probing into what you got going on. So, all right, so number 3, so top 10 mortgage questions for 2024. What is the difference in this? If you are a seller, you better know the difference, because there's a lot of different lenders out there that submit a lot of different things for this. And if you're a seller, you're going to want to know the difference. So what is the difference between being pre-qualified and pre-approved? So let's start with pre-qualified.
All right, ring, ring. Ken. What's your name and social security number? Do you have a salary? Yes? Okay, cool. I'm gonna check your credit. Hey, Ken, you've got a 750 credit score, and you said your salary is X amount. You're pre-qualified.
Okay, so pre-qualified is just like a check your credit. You said you make 100 grand, you're pre-qualified.
If you say you want to make this house payment and that matches up with the income you claim that you have, I'll believe you.
All right,
call that
so,
stated
but
income.
as an agent, as a homeowner, as a buyer, does that pre-qualified do me any good? I mean, it gives me a basis, but
It gives you. I mean, you definitely know that there's probably some kind of option for you, but does it really uncover that you have a side job, and when you turn in your tax return that you wrote off $40,000 loss because you are a Mary Kay representative, and you just bought all the Mary Kay and wrote it off because you didn't sell any. Some people use that as a tax strategy, and that can offset your other income when it comes to qualifying, especially if you have to open up your tax returns because you have maybe a rental property, because we have to see that kind of stuff.
okay. So take that what's worth. Probably if you're a seller, you're probably not accepting a pre-qualified person, right?
You should think twice.
You should probably say, we need you pre-approved. So what is the ring happen when you get pre-approved?
So I talk to you on the phone, and we go over that, and then I say, great, let's get your pay statements and your W-2 statement and maybe even your tax return, so I can really dial in exactly what your total financial situation is. Not only just to get, check a box, are you pre-approved or pre-qualified, but what's the best financing option for you? Because just because you can buy a house doesn't mean that you should put 10% down versus putting 20% down. You need to figure out what's right for you. So as a home buyer, being pre-approved and being thoroughly, accounted for with the process of the home buying process and the home approval process, just going to make the excitement level when you're going through the escrow process. It'll be a lot smoother because you won't have to worry about wait, why are they now asking me for the tax return? And why are they asking about that line item, that the Mary Kay thing? I just, why didn't you bring that up back at the beginning when I first talked to you on the phone? Well, that's because that's what a full pre-approval would do before you make the offer on a house.
Get pre-approved. We probably wouldn't work with you unless you're pre-approved, because we just don't know what you're capable of, based on all this stuff. A seller, if there's a good listing agent, if we list the house, we're not accepting a pre-approved letter or a pre-qualified. We want a pre-approval. We're going to call the lender, make sure it's good. So if you're serious, get pre-approved. Number 4, so 4 out of 10 here. Here's the question that a lot of people ask, especially with interest rates at 7%. How much home can I afford?
Well, so back to the approval process, how many liabilities do you have? So if you don't have, I have a lot of people that they paid off their car, they only have a couple little credit cards, so their minimum payments are very minor. You can get approved for a lot higher percentage towards the house payment, right? So if you could have 40% of your income, so let's use $10,000 a month as just a simple example. You could have a $4,000 a month mortgage, that'd be 40% of your income, and still have room for some minimum payments on your credit cards and still be well under 43%. I've seen house payments get approved at 45+% of total qualifying income. So it's got to be the right move for you. So what's your budget? And is that, do we have the whole picture? Are you qualifying, and then you also have a third party that's going to help you make payments? They're just not on the loan. A lot of times that's what it is, the boyfriend-girlfriend situation. One person qualifies in their name, even a husband and wife. They don't want one person to be on the loan because they've got bad credit, but they have a job, so their income might help make the payments. I hope so, because if you're spending 45% of your income on a mortgage payment,
not a lot left over.
Not a lot left over to pay.
So be careful. Don't just, there's lenders like Rocket Mortgage. What I'm not going to say exactly. Sorry, not Rocket, but any mortgage ones out there. Oftentimes they'll give you more than you really need. Make sure you can afford it.
Yeah, make sure you can afford the payment.
And that's what we want, because we saw the devastation of 2009, 10, 11, 12. Make sure you can afford it, because things do happen.
Yep, shit could happen.
So we're at number 5. How much did you save for a down payment? And why not 5% versus 10% versus 20? What do you get the more you get down? The 20%. So that's the question after.
Okay. Well, you could put as little as 3% down for a first-time homebuyer loan program with a conventional good credit score type loan. You should put down as much as you can to get your payment in line with your budget. So if you can only put 3% down, you're going to be limited on the price that you can purchase on a home, compared to the same house. If you put 20% down, the payment would be like half as much because you wouldn't have mortgage insurance. So big advantage. If you can put 20% down, you can avoid monthly mortgage insurance. If you can put less than 20% down, there are still options to help, whittle away at the extra expense. Mortgage insurance being really is insuring the mortgage company that you're going to make your mortgage payments. So if you don't have to pay for that insurance, it's just going to help you save. Yeah.
Yep. Okay. Number 6. We're cruising here.
Mm-hmm.
This is a longer episode, but well worth it. This is a good one. We get a lot of questions from people. How do you know which loan program is right for you? So I'll give you the top ones and you list them off. Okay? Or I'll give you the ones that I have down here. So we have adjustable mortgage.
Adjustable rate,
Adjustable rate mortgage, ARM. Federal housing, FHA loan. We have a VA loan for veterans and fixed rate conventional loan. So let's start with ARM.
Well, I'll put them in order of ideal. If you're a veteran and you have the VA loan eligibility, that's the best loan that there ever could be. There is no mortgage insurance on those loans, and you can put no money down if you want. You can still put money down. And disabled veterans, if you've had a 10% or more VA disability award, there's no extra fee. They call it a funding fee. So if you can qualify for a VA loan, that's the top of the list. Conventional loans, I just mentioned 20% down, that cuts your mortgage insurance out. That's a great loan program for most of the general public. The FHA loan is great for first-time home buyers because you can put so little down, but it also is flexible. If you had a mark on your credit report because you didn't pay a gym membership when you were in college and they sent you to collections and you forgot about it, and it held your score to 680, that might be worth looking at an FHA loan compared to a conventional loan where the private mortgage insurance company is going to charge you more for mortgage insurance particularly, but also in your interest rate to have a lower credit score. So flexibility. An ARM, it just has to be the right move for you. The lending industry has gotten away from ARMs because of the 2008 to 2010, debacle.
Are there any ARMs?
There are absolutely ARMs, but the pricing on them. So basically, an ARM is so think about it like this. If you take a 30-year fixed mortgage today at, let's just call it 7%, how likely are you going to be to refinance that loan if interest rates were to drop? Extremely likely. So if you had an adjustable rate loan, unless you got some kind of a huge discount, which right now we're not seeing, you're actually having to pay points or fees up front to get the adjustable rate loan. So the only time I see that is if it's a specialty type product. We do have programs for investors that are in a short-term type situation. They want to use a 3-year ARM and a DSCR underwriting to qualify the deal up front, and then they're going to remodel the house and bump up the rent. Well, in that case, they're not going to keep that loan. They have a strategy that's going to be less than a 3-year time period. That's likely the only opportunities that make sense with an ARM.
Be careful with ARMs. We saw a lot of people get in trouble.
Yeah, if you're going to live in the house for more than the time period of the ARM, it's probably not a good idea unless you're going to save a significant amount of interest, and we're just not seeing that advantage.
So the spread between, what is an ARM right now, a 5-year ARM, do you know?
If you were to take a conventional ARM, you're basically going to see, the same interest rate. It's just going to be a variable on how many points you might pay.
Okay.
So, and I think that's one of your other questions, if I remember.
Yeah, so number 7, top 10 mortgage questions for 2024. How do interest rates affect your mortgage? Pretty self-explanatory, but
yeah, well, if the interest rate drops, if you already have a mortgage, the interest rates don't matter, right? So this is kind of back to the problem of your 2.5% interest rate is such a good interest rate that you don't want to replace it. So if you have a loan at 7% and the rates were to drop, you could refinance it if you've already gotten into a house. But on a day-to-day, like if you're looking for a house, interest rates can either take away your buying ability because that payment could go up while interest rates, just a couple weeks ago we were looking at 6.8% and now it's up just a little bit. So it can affect your buying power while you're out there looking for those limited inventory homes. And you've got a specific price range you're looking at. Your payment is literally floating up and down as you're searching for a house. So the timing just has to be right.
Yeah, so if mortgage rates were to drop to 5, I think that we would have a surge in the market here just because then people could justify unlocking their rate at 3.5%. So that's in the way of benefit. Now, this, correct me if I'm wrong, go ahead.
We'd have a lot more buyers really ready to jump in, which would make this, multiple bid, multiple offer type scenario just like it was back in 2021.
So it's tough out there. Also, correct me if I'm wrong, approximately 1% increase. So if we're at 5, it increases to 6.
Mhm.
I've been told it's like 90%. You lose 10% for every interest. Is that something you've heard?
There's a bunch of rule of thumbs on that. I don't know.
I've been told in my career you lose about 10% every time the interest rate goes up a percent.
Yeah,
So,
and I mean, I
it's
guess
in the ballpark.
the inverse could be if it goes from 7 down to 6, you could just increase your buying power by 10%.
Okay, number 8, 2 more, longer one. Appreciate you sticking in there like our videos. This is a good question because it comes up a lot. And people sign a contract and they don't know what this means. So this is a really good topic. How do you lock your interest rate? So when we sign an offer, if you thoroughly investigate it with us, there's a little section on there in page 1 around item 20. It says rate lock. How many days till I lock my rate? What does that mean and what is your recommendation for that, Brian?
So like I said a minute ago, you're floating until you actually like have a home and a time period that you want to lock in on. So if you sign a contract, you say you're going to buy this house and close in 30 days from today, as soon as you go through your numbers with your lender and look at the payment, as long as you don't have any reservations about the house, you should probably lock in the payment so you don't have anything changing, because underwriting is going to verify your payment for the mortgage. So if you were to float, let's just say you think the Federal Reserve is going to meet next week and you think they're going to lower interest rates. Well, you could wait and see what happens, and the opposite could happen, and this has happened in the last year or so. The Federal Reserve has been, they have not helped out the market at all, and they've continually either rose rates or said that they're going to leave them higher for longer. So you could lose out and have a higher interest rate or higher cost associated to your loan. But the inverse of that, and here's the gambling side of Nevada, you could just roll the dice and maybe you get a lower interest rate. But if you're happy with your payment, my suggestion is to lock in once you at least have cleared your home inspection.
Yeah, especially right now because it's so hard to find a house. So if you like a house, you're in escrow. And we have a window, so there's something on the contract. We usually put 14 days. That's from when you sign. And you really like the house, lock the rate. Because otherwise, things can go bad and they can go up.
Well, and you lock the rate on that house. So if everything goes sideways and the home inspection uncovers something, skeleton in the closet you weren't expecting, and you decide to cancel, you cancel that loan lock and you cancel that loan and you start a fresh loan on a different property. Yep. So the loan number is specific to the property address. That's actually when the loan officially begins. That's when you can lock your rate.
Okay, so a lot of people don't understand what that is, but that's what that is. So number 9, good question here, because we're getting a lot of questions right now about how to buy down rates. But what are mortgage points? So someone says 1 point. Please elaborate. Let us know what that means. So if I'm going to buy points, what is that? And
well, points plural. So let's just start with the singular here. 1% of your loan amount. So if you're buying a house and the loan comes out to be a $500,000 loan, 1 point is 1% or $5,000. That might mean the difference between 0.25% better on the interest rate. So let's say you can lock in at 7.1% for no points, but you might, with you to pay a point or 1%, it might get you down to 6.875. Now that's going to be dependent on your credit score. So if you have a lower credit score, that same 6.875, let's say with a 699 credit score, for instance, might cost you 2 points for the same rate that cost somebody else 1 point if they had a, say, 750 credit score. So there's a scale depending on your loan to value. If you put
in the time of year, right? Well, it's not time of year,
not
but
time of year.
But where we're at in the market, right? Because sometimes you can buy it for 1 point, you can get 0.75 or 1 point some days.
Yeah, I mean, so loan investors they don't expect these loans to stick around. If the news is that sometime this year the Federal Reserve is going to start to cut interest rates, that would mean that we could potentially lower interest rates over the following couple years. So if interest rates are going to come down over the next few years, the likelihood of you paying the 7% interest rate for more than a year or two is very unlikely. So as an investor for a loan, you're expecting to get this rate of return. It's a 30-year fixed mortgage. You'd like to get that rate of return for more than a couple of years. So if you pay some cost up front, that's an incentive for you to keep the loan a little bit longer, and then the lender gets a little bit more up front, so that because they're not going to make quite as much in interest, but they don't really expect you to keep the loan all that long anyway.
Okay, so Brian might punch me for this, but I'm going to say how it is. The average person right now in the United States holds on to a house for 8 years. Probably less. So I've seen people in the past, some of our clients, buy interest rates down. And you gotta do the math, right? So if it's gonna save you $100 a month, you take $100 a month times 12 divided by
The
cost, and that's how long it'll take you to pay it off. It's rarely worth it. Most people move. Most people right now, with the Fed saying general consensus is rates are gonna drop, I wouldn't go out and rush to buy a percent or a point down right now. I'd be very hesitant.
And you said points earlier. I mean, I have had people pay 2-3%, but it's usually because they have some kind of a seller incentive.
Yes.
Because the lender can't charge more than 3% of the loan for total cost to the buyer directly. Now, indirectly, if the seller has a, what do we call it last? Well, I always like
incentive or
how about a deferred maintenance credit? I like those. Right, so like you do your inspections and you come back and say, you know what, it's going to cost me a couple grand to fix these things that you didn't fix on the house. So instead of me waiting around for you, I'll take an incentive to just move forward as is on the property, and you can pay $5,000 just to say towards my closing cost. You could in turn say, I'll take that $5,000 and apply it towards my loan because that saved me 0.25% on my loan rate. Maybe that's more valuable to you than the actual having the funds in hand for you to go spend that $5,000 at Home Depot and fix whatever.
We do have people who buy down the rates temporarily, a 2-to-1 buy down.
Yep.
So what is a 2 buy down?
Temporary buy down is basically this: you take the seller's money. It's pretty expensive. If the rates say 7%, you can get the first year at your effective rate is at 5%. So you take the difference. So that interest, the 2% is still there, but we're taking money from the seller or some third party and holding it into account and subsidizing your payment for that first year to get you a 5% effective rate on your mortgage.
Back up too.
Then you go to 6% the next year, and then your 30-year fixed rate would be 7%, which is what you have to
So we do see that to get people in some properties. So
a lot of home builders use that as an incentive.
Yeah, a lot of home builders.
Carrot.
Yeah, to get you in the property, and then the hope is before the second year is up. The hope.
Well, the bad joke is that you marry the house and date the rate. It's disgusting, but it's kind of the funny way of saying you don't have to keep this loan forever.
But be ready to, because it's just rates may not go down. So
that's true.
That's just the reality of it is they haven't gone down. We're still at 7.
It's been 2 years and they haven't gone anything but up. So every time we get a little bit of a pullback, then it comes right back up, and
I said for about 15 years that they were going to go up from 3%, and they never did. So no one can predict that. So just make sure you can afford your house, because we've been in this business long enough. We don't want you to.
Yeah, afford your payment so that way you don't have to sell it in a hurry.
Yeah. So love your rate. So last one. Sorry for the longer episode, but this is good. Really good information if you're out there. Share our videos. Question we get. So buyers have a mortgage payment due every month.
Yep.
What is included in that? And I'll kind of go through it, and then you kind of talk about the principal, the interest, the homeowners, taxes, PMI. So kind of go over those. So the principal and interest obviously is what?
Well, that's the loan payment. I mean, it's a 30-year loan payment because part of your payment goes to the principal, so it reduces your balance every month.
Yep.
And then the other part's going to the interest, so that you're actually going to reduce the interest every single month and accelerate the principal payment on each payment. That fixed payment, though, stays the same, and then we add to it. Typically, it's impounded for property taxes, homeowners insurance.
If you do mortgage calculators, you'll see P&I. So P&I is principal and interest, so that's one.
So that's missing the taxes and insurance, which is an important part.
And then, that's missing it, because a lot of people will just put P&I in there, and then they'll get from Brian. So lenders want to make sure that you have homeowners insurance on your property, correct?
You would like to make sure you have homeowners insurance.
But particularly...
Yes.
So
we would like the collateral insured to make sure that if it burns down, that somebody will put it back together.
So every year, the mortgage company calculates what the insurance is, and they take that out every month, correct?
Yeah, we get an annual bill from your insurance company. So when you purchase up front, you get a quote from your insurance agent, and then that gets paid at closing for the next year. And then we take 1/12, put it into your mortgage payment, and collect that. So that way, next year when we get the full bill, so let's say it's $1,200 for the year, we already have the money set aside in your monthly payments to cough that up out of an account just for you.
All right, so quick question. 10 years ago, several people, or a lot of our clients, were asking to get out of paying that through escrow. Can you do that still?
Yeah, you absolutely can waive it. You have to put 20% down. The lender is going to require mortgage insurance if you're putting less than 20% down, which is an added cost into the monthly payment. And with less than 20% down, you're oftentimes going to be required to include taxes and insurance. But here's why people used to not want to do it. Well, years and years ago, up until just recently, you actually got interest on your savings account. Well, now you're getting interest on your savings account again, but you actually get paid interest. So you get a 1099 from your mortgage company on your escrow balance.
No way. Are you serious?
Yeah, I just got a 1099.
Oh my, so they're 1099 you for holding the money?
I got $2.55 or something like that on a 1099. Yeah.
Oh my gosh.
From the mortgage company.
Oh my gosh. Okay. And then property taxes.
And property taxes, depending on your state, but in Nevada, you're paid 4 times a year, and they're not exactly every 3 months apart. So we just have to balance and budget that, so that way.
But that's included in the mortgage payment.
If you're going to include impounds, yeah. And the biggest thing is the lender doesn't want you to
Foreclose them.
Yeah, well, if you don't pay the tax man comes. You might have a first mortgage, so your first lien is the mortgage company. But if you don't pay your property taxes, they will get paid before your mortgage company if it all were to go into default.
Yeah.
So the guaranteed the government's going to get paid. The lender would like to make sure that that doesn't happen, and that you keep your house, pay the mortgage off, and live happily ever after.
And PMI is included in there, correct?
Yeah, if you have PMI, we would include that in your payment for sure. Unless you got tricky and paid it up front, which some people back in the 3% loan days prepaid.
Don't do that.
Well, if you had a 3% loan, it worked out really great.
Yeah, 'cause
you would not do that in today's market because of the current rate. You're likely going to refinance.
Likely, don't be.
It's a whole nother video on mortgage insurance. We'll do
Yeah,
that
so
one later.
let's just go with the basics and get what is called par, pay for it if you can, unless the seller's offering something, because you're not gonna stay in the house, it's likely gonna be refinanced. So just make sure you run the numbers, and that's why.
Run the numbers and do what makes sense to you.
Okay, anything else? So what's going on this week? The Fed, CPI is coming out, what's the magic crystal ball of Brian Cushing?
It's going to be hot outside before we see the Federal Reserve lower interest rates. That's my prediction.
Okay, so if you're out there, don't be waiting. A lot of people are on the fence. Oh, the interest rates are going to come down. Prices are going to come down.
Well, we've seen prices aren't coming down.
Prices, the demand. I'm just telling you, we're working with 10 people right now. 10, more than I've ever worked with. And that, where we've been doing this, the demand is real, and the supply is
not
lackadaisical at best. So. We're not suggesting that you go out there and get something you can't afford, but I don't think things are going to slow down. So,
doesn't feel like it.
All right.
Well,
Thanks for
that's
coming
great.
in.
Thanks for having me out again.
Again, if you like our channel, we're almost to 300 subscribers. Doesn't seem like a lot, but we're growing. We're getting lots of views. We're getting lots of views, over a couple thousand. So please like, share, subscribe. Comment below if you have any questions on any of the questions we just went over.
Yeah, please do.
Or if you have any videos that we want to do on mortgages or real estate. So, till next time, you guys take care. Enjoy the rest of the week. Thanks.